Okay, now we're looking at 16.3, which is the balance sheet. The balance sheet, hopefully you know this, shows assets equal liability plus owner's equity. Right? That's our accounting equation. We have to always have it in balance. This is a balance sheet is something you could do any day, anytime, and everything should be in balance every single day. Okay, if you're recording all of your entries like you're supposed to, debits equal credits. Okay, so in our heading, we are still Superior Corporation. The what is the balance sheet. And for our date, our when, we don't include the words for the year ended like we did in the last two, because number one, this doesn't have net income on it directly, okay? And number two, this can be done any given day. So what we're saying is that on this day specifically, December 31st, this is our balance sheet. Assets equals liability plus owner's equity. And we can prove that it is in balance. We could do this at any time, and it should always be in balance. It shouldn't just be at the end of the year. Okay? All right. So, of course, there are the three main sections: the assets, the liabilities, and the owner's equity, or the stockholder's equity in this case. So we're going to divide it into those sections. If it's, we started off at the very beginning of accounting 1 where we had a very small balance sheet, and we were able to do it side by side. So we had assets on this side equals liability plus owner's equity on this side. But this is a lot longer, and so it's going to go down the page, and it'll all be completely vertical. Okay, so we're going to have our headings, right? Here's assets. And we're actually going to divide assets into two categories. We're going to have current assets, and we're going to have planned assets, or what we might call long-term assets. So these are more short-term. There's going to be a quick turnaround within the year. It's going to be going up and down. We're going to be buying. We're going to be selling. Cash is going to be coming in. Cash is going to be going out. We're going to be buying insurance, using insurance, buying office supplies, using office supplies. And so it's a short-term thing, right? It's current. And then the planned assets are going to be more long-term, because those are going to be our bigger things like our equipment. Okay? All right, so this information is coming from our adjusted trial balance. So we used this side to create our income statement. Now we're back to this side. We've already labeled them. Here's our assets. Here's our liability. Here's our owner's equity. Remembering that this is after adjustments. It's our adjusted trial balance. It's a part of that worksheet that we worked for a long time to be able to create, making sure all those numbers were correct out of our ledger. We looked at everything that got used up in our adjustments and are coming up with these final numbers. Okay, so this is where I'm pulling all of this from. Now, a couple of things I want you to notice are these numbers up here in the asset section that pop out as credits, right? All assets are debits, right? That's the normal balance for an asset, is the debit, okay? So these numbers that pop out over here as credits, there's actually three of them: allowance for uncollectibles, accumulated depreciation, office, and accumulated depreciation store equipment. These are those contra accounts to the account that's right above them. Okay, so this is a contra to accounts receivable. All right, and this is a contra to office equipment. And this is a contra to store equipment. All right. So those contra means it's going to decrease that main account. So here, accounts receivable, that's what people owe us, right? But we have to understand that not everybody is going to pay us. And we have to be prepared for that. And so, and this is something that you're going to be doing in the next lessons coming up, is understanding this better and calculating the percentages and things like that. But basically, we have an estimate as to how much people are not going to pay us. And so in our balance sheet, we decrease our accounts receivable by that much, just so things don't get out of whack and inflated when people don't pay us like they're supposed to. Okay? And then down here, for office equipment and store equipment, these are bigger purchased items. It could be, things like copy machines. It could be cash registers. It could be, who knows what. And some of this could be, trucks and tractors and trailers and big items that you keep for multiple years, right? Well, whatever you buy that amount, like right here, we bought this office equipment for $19,916. Okay, we bought it for that. We're always going to keep that initial value on our books as what we bought the equipment for until we sell it or get rid of it. And there are lessons coming up on that and how that happens. But every year we decrease the value of that equipment because there's no way we could sell it for that amount. Just like when you buy a car, right? As soon as you buy the car and you drive it off the lot, there's no way you can sell it for the same amount you just bought it for. That's depreciation. Okay? So what we're doing is every year we're figuring out how much to decrease the value of those long-term assets, those big assets. Okay? So that's what is happening here. We're decreasing the initial purchase price, decreasing the value off of the initial purchase price to give us a more accurate reading of the value of that equipment. Okay? All right. So we'll keep going. Basically, like I said, I'm pulling the numbers from that balance sheet. So we've got cash. Now we've got 3 columns. Really, this first column we're just going to use for those couple of accounts I just talked about to calculate that contra part. This second column is going to be the big list of everything that we've got in assets and liabilities. And then the third is just going to be those main numbers of assets equals liabilities plus owner's equity. Okay, so I'm going to go ahead and put cash in this middle column. Make sure I get the right spot. 4335547. Okay, and then petty cash is 200. And then accounts receivable okay, and this is the one that we're going to have that contra account to go with. So we're actually going to use this in this inside column. So 16,305.45 is what comes off of our adjusted trial balance, and then we have the allowance. So we can actually put less the allowance for uncollectible accounts. And this will be 2484.22. And then we'll do the math, so it'll be minus, and we'll just equal it right here. So that'll be 13. So now this will be our actual accounts receivable number that we're going to use, 13,821.23. All right, then merchandise inventory. 81,017,26, and then supplies office, okay, y'all can kind of see where I'm getting those numbers. So 77765, and then supply store, $51636, prepaid insurance. Remember, these have all been adjusted, right? We've used up some things throughout the year. We've got that all figured out. Oh, nope. Let's stop right there. Okay, so after interest receivable, these are our short term. These are our current assets. So we're going to go ahead and do a total here for total current assets. Okay. So now we're going to take all of these numbers, right, add them up to get this number, and that will be 147,542,97. Okay, so that gives us a total current assets, and then we're going to separate into those plant assets. Okay, and this is where those big things are coming in. So here's office equipment, right? And these are going to be, these could also be called long-term assets. All right, so here's the office equipment. $19,916. We're going to use this first column because we're going to take care of that depreciation, right? And this was the original price. That's not going to really change unless we sell some of this. I don't know what's in there. It could be multiple items. So if we sell one thing, then that number might change, but that number is not going to change until we actually sell it. And then we're going to have less accumulated depreciation. And we say accumulated because we're keeping track of this for the entire life of the equipment, from the day that we bought it to the day that we get rid of it. Okay, so this is 12,436. And that number's so big, we've probably had this stuff for a while, right? Okay, so we'll take this and we'll subtract it, right? And then the value of the office equipment that we're actually calculating is the difference. So 747994. Okay, so that's our actual, we're saying that this is the value of our office equipment. We bought it for 19, but it's only worth this right now, and so that's what's on our books. Okay, the same thing for store equipment. Less the accumulated depreciation for store equipment.